Hello everyone, Dave Keller here with Market Misbehavior. As the market is moving to new all-time highs, the S&P 500, the NASDAQ 100 this week, again blowing out previous highs and continuing to push onward and ever upward. I'm often asked, well, what does a bad chart look like, right? What does a bearish chart look like? When we're surrounded by all these charts that seem to be working, like Facebook and Alphabet and even Tesla and others that are turning to the upside, what are the charts that aren't working and what do those actually look like? Number one, we should be thankful that we're in a market environment where it's actually very hard to find negative charts. But today we're going to talk about the characteristics that make a chart less attractive and more negative and show more of a pattern of trend weakness versus trend strength. So today we ask the question, what does a bearish chart look like? So in the normal course of my work, working with clients, working with viewers on StockCharts TV, I'm often highlighting charts that are breaking out and charts that are breaking down. A normal part of my process is actually to screen for stocks making new 3-month highs and stocks making 3-month lows. I've done that for years as a way to just identify things that are starting to turn up and things that are starting to turn down. Also things that are in established trends. What's happening right now is you have a great number of stocks on an average day that are on the new highs list, and you relatively speaking have very, very few on the new lows list. And in fact, looking for stocks above a 10 billion market cap on an average day, it's usually a handful, less than 10 stocks on an average day making a new 3-month low. What I wanted to do today was highlight one of the stocks that came up on that screen in recent weeks and show you the characteristics of what actually makes a negative chart. And the reason why I think it's important to talk about now while everything looks good is when you see the average chart start to look like the one we're going to highlight in a moment, that's when you know that market conditions overall are starting to deteriorate. Before we get to that, if you like this sort of thinking about investor decision-making, behavior, market psychology, and so forth, I'd love if you'd subscribe to my channel. It'd be great to have you along this journey with us. Also, give us a thumbs up if you would. We'd very much appreciate it back. Finally, put a comment below. What do you think about the chart that we're going to show you? Do you understand the bearish argument? And what other stocks do you think also are looking bearish right now? Put the comment in the below the video if you could. Let's get to the chart. All right, so for today's example, we're actually looking at a chart that I would argue is relatively bearish, and that's the chart Conagra Brands, CAG. And this is a stock within the consumer staples sector, pretty decent size, 17 billion market cap, plays a dividend yield that's fairly healthy, about 3%, which is overall very good. So what are the characteristics of this chart? We've talked a lot about the characteristics of strong charts because we've been highlighting so many of them as the market's in a cyclical uptrend within a secular uptrend, right? So we have things like Facebook and Apple and Alphabet, and a lot of the FANG stocks are coming to mind immediately, but things that are breaking to new swing highs, things that are pulling back to their 50-day moving average and then breaking out to the upside. So we don't often, in this sort of environment, highlight a lot of charts that are actually looking bad because there aren't too many of them. But there is an example that I found this week, Conagra, that actually represents, or I think characterizes some of those conditions that would suggest more of a bearish configuration. Let's talk about what they mean from top to bottom. So here we're looking at the last 2 years. We're looking at a daily bar chart. The first thing that jumps out of here is what's called a failed breakout. Now, if you look, Conagra accelerated to the upside into a high in late August of last year, pulled back, and then had what's called a rounded bottom is what you usually call it, but it's basically a basing pattern. We have a resistance level around 38.50 or so. That's the same level we came back to in March. You can see this pattern, sort of this bowl-shaped corrective pattern as we traded down to around 33, down to 32 the next time, but overall continued back up to previous resistance. Now, this was setting up really, really well here in April and May and into early June as a potential breakout candidate. And actually in the first week of June, it broke out of this base in what you might consider a cup and handle pattern, which is a big, broad bottoming pattern, a cup, then a shorter, shallower correction called the handle. You break above the rim of the cup or the neckline, and that indicates high potential of higher prices. But in fact, about a week later, this became a failed breakout, and that is when you have a breakout above a key level, but it never really follows through to the upside. You never really had that follow-through day that indicated this was not just a fluke. It indicated that there is broad buying power that's building and pushing demand higher, and pushing price higher as well. We had a failed breakout, which means it broke out briefly, but then turned right back down, and now it's back to the lower end of the range. What we also note after that failed breakout is the fact that it's broken down through the 50-day moving average, which had served as resistance in April and May, breaking down through that, testing that from below, and then breaking down even further. Now it's broken down through the 200-day moving average, which is where it also bounced in early April, we've now broken back below that key long-term barometer. If you look down at the RSI, you can see the RSI has become oversold recently. And even though it broke out above the 60 level here in March as it was retesting the previous highs, for most of the last 6 to 8 months or so, the RSI has remained below 60 on rallies, and it's gone down to the oversold territory on pullbacks. And overall, that is more characteristic of a bear market phase than a bull market phase. Really, since the August high of last year, for the most part, the RSI has been more in a bearish range, except for that brief period in March. Overall, it's been more negative than positive. The real, concerning piece of evidence here, I would argue, is the relative strength at the very bottom. If you look at the last year plus, even 14, 15 months or so, the relative strength line has been trending downwards, which means really since that initial thrust out of the March 2020 lows, the acceleration into the April peak, from that moment on, Conagra has been failing to keep up with the overall market trend. The average stock has been performing much better than Conagra. As a result, the relative strength line has been trending downwards. You can see just this week, it's making a new 12-month relative low, which overall is the sign of a weakening stock. One of my mentors used to say, if you want to outperform the S&P 500, own stocks that are outperforming the S&P 500. Owning CAG for the last 12 months has certainly not helped you do so by any stretch of the imagination. So overall, those are the characteristics of a bearish chart, in my opinion. Number one, a failed breakout, the potential to break to new highs that did not materialize, and what could have been a very strong buy signal actually evaporated very quickly. Number two, breaking down through some key moving average support lines. So breaking down through the 50-day moving average, breaking down through the 200-day moving average, and now the price is below two downward sloping moving averages, which is another negative sign. The stock recently became oversold, which means, could you expect a bit of a bounce here? Absolutely. But overall, the fact that we're becoming oversold and we don't get above 60 on rallies is more characteristic of a bear market phase than a bull market phase. So overall, I would assume that the path of least resistance is most likely lower. The most concerning item on the chart, though, is the relative strength at the very bottom, continuing to trend lower. And until that line turns higher, overall, it's indicating weakness. So what would make an average bearish chart, which I'm showing you here, turn more bullish? Well, basically, all those conditions that I described would have to flip over, right? We'd have to regain the 200-day moving average, regain the 50-day moving average, get above the trend lines, or excuse me, above the moving averages, which indicate the smoothed out trend over time. We'd want to get above resistance and stay there, set a higher low instead of a lower low, which is what we've done more recently. So reverse this pattern of distribution that we've seen in price. Have the RSI get above 70 and on a pullback remain above 40, which would be more characteristic of a bull market phase. And most importantly, the relative strength line turning higher. Now, this is a stock within a sector, consumer staples, which has been a chronic underperformer. There aren't a lot of charts, maybe Costco maybe is one of the few that come to mind that have actually broken out and overall are holding up okay. But the average chart in the sector actually looks pretty weak. So the sector as a whole has been underperforming, and this stock in particular, CAG, is certainly an example of an underperformer and overall a bearish chart. So that's it. That is the answer to the question, what does a bearish chart look like? And again, I will reinforce the fact that if you screen for charts that look like this, you won't find very many. The average chart actually looks pretty good. And even stocks that have broken down have maybe broken below their 50-day moving average, but have not hit all of the criteria that this very bearish chart, I would argue, has done. Now, can this chart turn on a dime and go higher? Absolutely, but talking with people like Tom Dorsey, who wrote some great books on point and figure charting and on offense versus defense, he compared a lot about charting to football and basically American football, and basically saying, can you score when the defense is on the field? Of course, you're just much more likely to score when the offense is on the field. If you look at this chart, the defense certainly seems to be on the field until proven otherwise. If this sort of thinking about investor decision-making and focusing on investor psychology through the language of charting and technical analysis is of interest to you, I hope you'll subscribe to my channel. It'd be awesome to have you along this ride with us. Also, give the video a thumbs up if you could. It'd be great for you to do so. We'd very much appreciate it. Finally, put a comment below this video. What other charts stand out to you as being in similar bearish characteristics? Can you find any others that are showing some of these same criteria as CAG right now? From everyone here at Market Misbehavior, I'm Dave Keller. Be well, be safe. We'll talk to you again soon.